In last year's Future of Money session, in the context of hyper-connectedness of IoT, we asked what is more valuable, data or money? We learned that money and data are already inextricably linked, and that this could lead to new barriers for financial inclusion, that we don't always know where our data is or who has it, that issues of liability are unclear if you receive financial advice from a machine, and that the future of money will be determined by the data we have, the devices and platforms we use, and by the people we are becoming. 1 year on, and we see an increasingly successful adoption of advanced analytical and machine learning in other industries such as advertising, retail, healthcare, and oil and gas. And this is further increasing the expectations of businesses and consumers for the value that digital technology can deliver. We asked, what does this mean for financial services?
What does it mean for the customer?
How can organisations move from a transactional business model to one of customer enablement?
What does it mean for the way business is done?
How could financial institutions use data to drive better strategic business decisions?
What does it mean for regulators?
What does this new exchange of big data in financial services mean from a legal and compliance perspective?
What is the future of money?
Good morning, everyone. Welcome to the Future of Money. This is my first time at Sibos, and I'm honored to be moderating this panel. The folks at Swift tell me this is a session where we identify key trends that will dominate the financial services industry in the future, and where we capture the sector's zeitgeist. No pressure, then. This is also a homecoming of sorts for the Future of Money. It was launched 6 years ago here in Toronto. In today's session, we're going to be taking your questions and doing a few polls. To participate, please go to your Sibos app and select Plenary. Alternatively, go to slido/Sibos in your browser and enter today's access code, which is 2017 Sibos Day 3, that's the digit 3, to submit your questions. So in my preparation for this panel, I looked at what had been discussed in the previous years. We've had Bitcoin, cryptocurrencies generally, mobile payments, collaboration, disruption. Last year was the Internet of Things, and that's, to the uninitiated, of which I'm sure there are none in this room, that's basically where your fridge is going to talk to your microwave, and between the pair of them, they're going to run your life. For some of us, they do already. This year, the topic is all about data, how it creates value, and how it is being used. I'm particularly excited about this discussion because I think there's been a realization in the financial services industry that data is the key to the future. It's the digital oil that can power new services and drive strategic change. I think this realization is one of the reasons that the traditional banks no longer appear to be so threatened by the potential for Silicon Valley to encroach on their world. They know that they already sit on a huge treasure trove of data. Of course, they can't be complacent. Google and Facebook are masters at refining, extracting, aggregating, and selling users' data. And the problem for banks is that while they might be sitting on vast reserves of information, their ability to retrieve it has historically been hamstrung by legacy IT systems. In many cases, multiple legacy IT systems, siloed businesses, and all the challenges that come with entities that are very often the product of numerous acquisitions. So right now, I think there's a very interesting scramble afoot in the financial services world over data. You have the large banks trying to utilize what they have buried in their own systems. You have fintech firms which have developed expert data drilling techniques, and some of these firms have gone into partnerships with the banks. And finally, there are the challenger banks, which combine the capabilities of a fintech firm with the services of a bank. As challengers, they are unencumbered by the bureaucracies and legacy systems, and so can be nimble operators. I'm delighted to say that for today's discussion, we have representatives of all three to talk about data. We're going to talk about where the financial service industry currently stands in this scramble for data, where it can go, and what's next. Some of the questions we will be answering today will center around how best to use data to drive the customer experience and generate new services, how it can help in the pricing of risk and also sparking big strategic changes. One area that we will certainly be spending some time on is how to protect customers' data. We have seen with the Equifax hack how customers are becoming increasingly aware of how exposed they are to having their information stolen. They're facing a new sort of identity crisis. How good is the industry at protecting that data? What kind of guarantees can it offer? And what are the role of the regulators? Of course, as we have seen with the SEC hack, even they can be the target of cyber criminals. To help us answer some of these questions, we have a great lineup of people from different parts of the industry. First on the stage will be Ather Williams, Managing Director and Head of Business Banking at Bank of America Merrill Lynch. His division serves nearly 40,000 mid-sized US-based companies. Ather was appointed to this role last month. Before that, he was Head of Global Transaction Services. Representing the world of challenger banks will be Megan Kaywood. Megan is Chief Platform Officer at Starling Bank. Starling was founded in the UK in 2014. A mobile-only bank, it offers customers a current account that allows them to keep track of their spending. Finally, from the world of fintech, we will have Richard Coe. Richard is the founder and CEO of M-DAQ, a capital markets financial technology startup founded in 2010. M-DAQ wants to create a world without currency borders. It partners with global FX banks to ensure small businesses and other clients get the currency products they need. But before I start inviting the guests onto the stage, we're going to have our first question. So I think if you can go to your app. And the question is going to be, what is more important, data or money? So this question was posed last year, as you heard on the video. And the result was very clear. An overwhelming majority of people thought that data was more important than money. So have a think about it. Make your decision. We're actually going to rerun this question at the end of the session to see if we've changed anyone's minds. Wow, so not as high as last year. I think last year it was over 75% thought that data was more important than money. Interesting. Okay, we're going to revisit that topic towards the end of the panel. For now, if Ather could come up to the stage. Yeah. Thanks. Nice to see you. Okay, Ather, how about for you? What's more important, data or money?
Well, for me, it's not an either-or. So I approach this from a customer point of view. And for most of my career, my companies or my clients have been large multinational companies. And if you look at the world today, non-financial multinationals have about $2 trillion of cash in their balance sheet right now. And we're less than a decade removed from a financial crisis to sort of rock the world. And so the first question their boards, their CEOs asking is, where's the money? What counterparty is it with? How risky is it? How do we access it? And that's the first and foremost thing. So I find it very difficult to say that they value data more than money, because the money is kind of how that fuels our company. That said, the data provides them with very interesting insights and how to deploy that money, that capital, to either grow their business, understand the counterparty risk of their customers, or think about how to find new customers. So it's a very tight loop, but still for me, the money is foundational. And even some of the companies, Carmel, that you mentioned in your opening, they're our clients as well, and they're worried about their money too.
Mm-hmm. Okay, and for you at Bank of America Merrill Lynch, what is the most innovative thing that you've done with data?
So again, we always approach innovation from a very customer-focused point of view. There's a lot of technology out there that many of them are represented here in this room or on the floor who are chasing a problem. We try to think about is what problem are our clients trying to solve? And if I take one that's really kind of top of mind for me, I would think about the challenge around real-time payments and remittance information around those payments. So there's been mass hysteria and focus and excitement around real-time money movement. Mm-hmm. But if you ask any corporate treasurer, who have usually on average less than 10 people in their shop, getting paid right now for something they don't know why they got paid is not very valuable. So tying the data with that is very interesting. So we've been focused on how do we close real problems like that. So recently we launched a product called Intelligent Receivables, mm-hmm. which basically used artificial intelligence on top of traditional lockbox technology to be able to look at emails, scan physical documents, text messaging, everything else, and pull it in and match it to the payment data and take our clients' match rates from like 15% to north of 90%, mm-hmm. which really creates efficiency for them. And so they can redeploy those resources to more value-added things.
So really cut down on the paperwork.
Absolutely.
And yet we still have checks.
We still do.
And we've been, we've had fintech forums for years. When are we going to see the end of the check?
I always like to say it's probably a little un-PC, but the people who write checks are going to die before checks do. But
fair enough.
But I think that the reality of the check, look, it's universally accepted. Mm-hmm. It's the same reason we still have cash.
Right.
It's universally accepted, and in the States at least, it's very, very cheap. When Check 21 went in and basically checks are cleared via image, the incremental cost of clearing a check item is very cheap. Where it gets expensive is when we obviously start taking them in to the handling and get them into the system, which is why you see all the banks in the US, and ourselves included, focusing on using your mobile phone to digitally capture the image of the check and prevent them from going to the ATM and, God forbid, going to a teller window.
And so what's your vision? Where would you like to see Bank of America Merrill Lynch go in terms of its use of data? What would be the kind of the ultimate for you?
So I think of it in terms of the client hierarchy you need. So the first thing is really enabling, so going back to that $2 trillion, the first question on the CFO and treasurer's mind is, what's the best deploy it? Should I make an acquisition? Should I build a factory? Should we hire new employees? Should we buy back shares? What's the optimization for our shareholders? In order to do that, they're thinking about a couple of things. One is, how do I free up my time to actually go do that? So first of all, it's about simplification of their operations. So whether it's using intelligent receivables to get rid of the paper, or thinking about how we're going to leverage the new real-time payments platform in the US to take the paper out altogether. Make it simple. The second thing is moving up then to risk management. So how do I really use data and insights to understand my counterparties and manage cybersecurity and fraud? Those are key things that are obviously, given the Equifax hacks and others you've mentioned, top of mind. And the last is really, I would call it proactive insights. So when that question comes to the CFO or the treasurer of what should I do with our capital, there's a mad scramble, is all we bankers in the room know, right? The capital markets guys get involved, the lending guys get involved, the transaction bankers are involved, and it's burning the midnight oil on floors in New York and London and Hong Kong, trying to figure out what's the best use. All that should be automated, right? That should all be pushed through and pulled together from the data that we have, as we know about their clients, about the markets, and about our other clients to say, here are things you should be thinking about proactively, and then have a banker actually service that. That's where I think the industry needs to go, is providing that proactive insight and really being that trusted partner, and not just an intermediary to a bilateral transaction on behalf of a client.
Okay. Now, you mentioned Equifax, I mentioned Equifax. How do you go about protecting your customers' data?
So it takes a village, right? So we have a very large tech budget run by our chief technology officer, and she and her team and our global information services group have a very clear set of standards about how we do it and how we comply with the myriad regulation around the world around data. Secondarily, it's about permissioning, right? It's really thinking about who has access to what. And I also think there is something to be said about thinking in the construct of what we can learn from distributed ledger. Is about, do you want to put everything in one place? Do you want to have things spread out? And how do you link them together to keep them safer? Those are all sort of recipes in the solution set.
And in terms of access to that, because that data is obviously very, very, lucrative. It's an important part of your value offering. What about giving third parties access to your customer data? Is that something that Bank of America Merrill Lynch does? Is there any house protocol on that?
So there's lots of stringent rules around that. I think it means that there's a couple things. Obviously, it starts with the customer and their permission. So if it's a consumer, there's a clear permissioning process to do that. And for a corporate client as well. And we've had some very provocative and insightful and forward-thinking conversations with some of our largest clients, some of the largest companies in the world, about if you permission us to do this, this is what we're going to do with it, and this is the benefit you're going to get out of it. Right. And through those and through very strict contracts around that data, you can get there. It's a process, but you can definitely get there. I think that the other aspect to really think about is how do you anonymize it? So what really needs to be known? Obviously, things like account numbers and names and personal identification has to be kind of wiped out. But the core set of that is real. I think that the value that we see, so for example, in my business and business banking, we have at any given time 200,000 companies that we're on our prospect list. And so we actually use some data enrichment and AI to take that down to 15,000 targeted companies that we know are creditworthy, because we were able to look at, as Bank of America, we bank roughly one every 2 households in the United States, 1 every 3 medium and small businesses, and 90+% of the Fortune 500, which is a massive network. So if you actually look at the connections between those prospects, our current clients, and the overlap, you can actually look at the flows and understand who's creditworthy and who's doing business. And that enables you to narrow things down and become very, very proactive.
Okay. I'm going to suggest that Megan comes up onto the stage now so we can hear the views from a challenger bank. Hi, Megan. Megan definitely deserves that round of applause. She got up and did a 5K run in the dark by torchlight this morning in Toronto. So well done, Megan. Can you tell us a little bit about Starling Bank? I mean, I mentioned it briefly in my introduction. It's a mobile-only retail bank in the UK. But if you could maybe just explain a little bit about it and where you want to go with Starling Bank.
Definitely. So we're known as one of the leading challenger banks in the UK, but we like to refer to ourselves as a tech startup with a banking license. So we were founded in 2014. And last year, we received our full banking license in the UK. And then this year, we launched publicly on iOS and Android. And that's key because we're focusing on the retail current account delivered via mobile. So we have no branch locations, no physical infrastructure. And what we're really looking to do is to focus our resources entirely on the current account, and then to build out what we call our marketplace, which is how we enable customers to access other financial products, mortgages, insurance, wealth management, via the Starling app. So it meets our goals of being able to focus on our core competency around retail banking, while simultaneously enabling our customers to access best-in-class other financial products from across the ecosystem. Simultaneously, though, we're also now going into business banking as well, and we've developed what we call our payment services division, which is how we enable other banks and other fintechs to access payment schemes through Starling Bank.
So would the plan be in the future maybe to get into lending, to get into mortgage? Is that the hope?
Yeah, definitely. So that'll be one of our big focuses for next year as we move into broaden out our retail current account, but also into business banking as well.
And so for you, what's more important then, data or money?
So I think the answer to that is difficult because they're so tightly linked. But whenever you look at data and you look at we commonly acknowledge now that data is the new oil. But in the UK, we have several initiatives. We have open banking, and then we have PSD2, which is basically mandating that banks open up their data.
Right.
You know that banks are sitting on this treasure trove of data. They feel very confident in that. And they've typically had this mindset of owning the customer data. So the way that banks make money is typically they incentivize a customer to join their current account or checking account and incentivize that with a loss-making introductory offer. So cash back on spending, free travel insurance, a cash lump sum perchance. And then they upsell them higher profit financial products like credit cards, mortgages, and loans. So the checking account or current account is usually loss-making. So, but what PSD2 does is it says you don't own that customer data. There are actually other fintechs out in the ecosystem who have better products with better user experiences and better prices, and customers deserve to have the transparency around what their options are and be able to securely share their data with them should they choose to do so. So it's really kind of shifting this view of data, saying now banks have this treasure trove of data, but they don't own it. The customer owns it. And by them owning it, they can share it with whatever other company that they want to. So now banks don't have this upper hand of just being able to upsell the customers on their own products. Now customers are getting easier access to the entire ecosystem. And so when you go to these conferences, you often see this, this image. It's called the unbundling of banking, and it's a picture of Wells Fargo, their website. And you see, for like every financial product, from insurance, mortgages, wealth management, there's an arrow, and it shows all of the different fintechs that are competing on each of these different areas. So I think because now you see all of these fintechs, and you see the shift of data ownership from the bank to the customer, that data is really going to be the foundational piece moving forward.
Okay, and PSD2, that's a new European law that's going to kick in January. So in Europe. So do you see then that as offering a great opportunity to Starling? Are you?
Yeah, definitely. So the way that we see it is that with this disintermediation of banking, what that means now is customers will have greater choice, greater access. For traditional banks, this is a huge threat because that means that disrupts their current revenue streams because they've built out all of these existing products and they have the full horizontal feature set already already existing today. But for us, we built the bank from scratch. We've only built the current account. So for us to enable our customers to securely share their data with other financial technology companies to access the best in the market, we can actually turn that into a core strength for us. Because what that means is we can build this marketplace in the app, a really strong network effects platform, such that we build this platform that's very easily scalable. Any fintech can basically plug into this platform should they have compliant APIs and meet our due diligence. And then we can build this platform such that we can enable them to bid in real time to service each customer requirement. So whether you need a loan or you need a mortgage, all of a sudden you can get the best rate through our platform because it's so competitive for the customer. And yet at the same time, businesses love it and the fintechs love it because that gives them a really good channel to meet customers. So it's a huge opportunity for us.
Aether, do you feel under threat? Do you think the traditional banks are worried about this?
Well, fortunately for me, we're not a retail bank in Europe, so no.
You've been easy at it.
But if I were, I would be, yes, it would be very concerning. But I do think, candidly, we've had very explicit conversations with our corporate clients about what this means for them in Europe and their access to their customers. And we've kind of adopted a framework we call the ecosystem orchestrator, right? So our role can be helping them manage that, because no bank, no CFO, treasurer wants to actually manage 100 banking relationships and 2,500, 3,000 bank accounts. They really want to manage one, which is not really practical given lots of factors. But our ability then to leverage the open banking architecture offered by this legislation does give us the opportunity to, on their behalf, manage their local bank accounts for them and consolidate that back into one view. We already do that through notional pooling and other cash concentration structures, but now you actually can more efficiently access and actually move money on their behalf and complete transactions. So it creates a different dynamic for us who's not in a lot of local markets. So I think that you enable you basically to build the overcapacity of banking in local countries and pull it together.
Yeah. The sense that we certainly get from covering Wall Street is there's no longer the sort of fear that there once was about Silicon Valley. Do you think that's fair to say, Aether? Do you think people are more relaxed about the challenge from the fintech world?
Well, I'd say that we're more understanding of the challenge of the world, because I think 3 or 4 years ago, even 2 years ago at this conference, it was blockchain was going to displace all the banks, right? And that clearly didn't happen. And I don't think it will happen. I think it might be an infrastructure that's going to be adopted to move money or information, but I don't necessarily think it's going to replace banking. But I think that banks have sort of pivoted from us versus them versus much more a collaboration approach. So we think of it as a partnership. And I think that's, the insights that can be brought that we're not going to build ourselves are amazing, and they're enabling for our clients. I think that's the approach we have to take. It's much more of a partnership, value added. It's not a zero-sum game.
Megan, for you, do you think there's anyone out there that could be the Amazon of the financial services world?
I think that's what Starling's hoping to be. So I definitely think that that's an opportunity. I do also think that tech companies such as Amazon, Google, Facebook will increasingly move into financial services, probably focusing on payments first, as we've already started to see them do. And so I don't think any of the large tech companies will want to take on the risk and regulation of actually being a bank. But I do think that multiple of the challengers, including Starling, we're all going to look at various ways of becoming the Amazon of financial services, such that we enable our customers to access a marketplace of goods. We focus on the retail current account, and we do that in a very efficient way with new technology that makes a platform that's very scalable and very resilient, but drives revenue in a very different way than we've seen from traditional banks.
Great. Well, let's get the word from the fintech community, and we're going to get Richard to come up on stage now. Thank you. So Richard, maybe you'd tell the folks a little bit about what M-DAQ does. Very interesting company based in Singapore.
We've been around for about 8 years. The whole idea was to bring the best of Wall Street, East Coast, to the West Coast. Because West Coast companies typically are startups, fintechs that's trying to, in a way, complement, some say disrupt the financial markets. But the product that we chose to deal with is foreign exchange. It's a little bit opaque to most of us, and yet it lives on in our everyday life. So if you are trying to, say, buy something in America from China through Alibaba, you are going to use your credit card at some point, pay renminbi, and somebody's going to do the conversion for you at 4 to 6%. And some of us here in the Far East trying to buy something from Amazon, has to do the conversion into US dollar and suffer the foreign exchange conversion. The problem is not so much of the 4 to 6% all-in rate, but it was this lack of certainty. In fact, last month, Amazon just sort of expired its one of the biggest patents, which is the one-click. It had it since 1999. And what this one-click does is that it allows customer to, or rather avoid this problem called shopping cart abandonment. Very often you pick something, put it into your shopping cart, and before you do a checkout, you kind of change your mind, and you didn't come back and see it through. So this actually accounts for a huge loss. Something like 70% of all the shopping carts were abandoned online, more than in the offline world. So with the one click, they actually reduced that. Right. So some even say that that accounts for something like 2.4 billion annual revenue for Amazon alone, just for having the one click. But the good news is that it has now expired in terms of patent. Everyone could have the same feature. So what we address this problem is beyond one click, beyond the shopping cart abandonment. Because today, if you're trying to buy something online, even offline, that is cross-border, you have this foreign exchange that you do not really know how much until it is all priced in at the end of the trade. And this could be a day later, 2 days, 3 days later. So how could you actually make a price comparison if you do not know what is your price?
Right.
And if you start to extend that into the realm of securities trading, where you're trying to buy a cross-border securities, and you're trying to get into the market, get out with just maybe 3-5 points difference in pricing, take profit. You can't do that because brokerage fee you can estimate, all the matching cost, the clearing fee, but the foreign exchange is actually done by your custodian bank, and you just have no idea how much that's going to be placed until a couple of days later. So you cannot really make that final call. So this is the equivalent of shopping cart abandonment in a financial world.
Right. We spoke before about Alibaba, which is obviously a backer of yours, and their use of big data. Do you want maybe to explain to the audience, when we were discussing this earlier, how they use big data to help them in terms of assessing people's credit?
So if you look at the e-commerce business, it's actually a business that allows you to collect an enormous amount of data. So if you were to look at it from a banking perspective, earlier on the discussion was that bank is collecting a lot of data on businesses or individuals' account. But that's only the banking data, official banking data. But there's actually the other part of your whole life that you live in, online and offline, increasingly online now, where banks are not capturing those data points. So for instance, if you do a credit score, you're able to find out from your salary, your years in your job, your assets, your mortgage, your dependents, what is your ability to pay. That part you can get it. But what banks are finding it challenging is to find out this other aspect, which is called the willingness to pay. You can pay, but you may not be willing to pay. But yet, on the other hand, if you were to, say, been a regular customer on Amazon, on Alibaba, and various other platforms around the world, this platform actually could know who you are as a customer or even as a small merchant. Do you buy like 3 shoes and return every 2 of them? Do you have the habit of doing things like chargebacks and all? So if you have that, then likely this data is very essential for the platform who may actually have a banking license or willing to lend out some microloans to know whether this person or this business is worth lending to. Because they may be able to pay or repay, but they are not willing to repay. So that's a bad customer.
Making a moral judgment about
Yes.
you. Right?
But if you look at the flip side, is that
Scary.
there are many small businesses in the world, and certainly with the retail market, that they have no access to credit because they just couldn't clear the standard credit score. They just nobody's going to lend them anything, whether it's a machine, expand their production, or do an export. But yet, microloans can be given because such credit data, which is sourced from non-credit source, is able to potentially provide this. Because in the world of lender and borrower, there exists this opacity, which is, I kind of term it as sort of like a deadweight loss in economics 101, where the borrower really wants to borrow and maybe willing to pay, but the lender isn't so sure. So if you're not sure, what do? You either don't lend out or you charge a huge risk premium. And this risk premium is unfortunately being shared by everybody, who is willing to pay. and yet the one who's not willing to pay is going to sort of enjoy the subsidy from that premium. So with the ability to bridge these two, using big data science, hopefully we could reduce the risk premium and allow more who needs credit to obtain credit, and those who shouldn't be borrowing so much, maybe the system will sort of keep them out, keep the wolves at bay. Yeah.
So data protection has obviously been a big theme of our discussion today, and it's been a big theme generally for the industry. Is it done any differently in Asia? You know, are customers protected in a different way? What's the climate like there?
Data privacy is a big topic, started in the Western Hemisphere, and certainly in many parts of Asia, this is becoming a legislation. So you have the Personal Data Protection Act. Every one of us needs to sign off to say, dear vendor, dear bank, you can use the data in any way that you like, including my email, my contacts, and so on. So they are taking it quite seriously now. At the same time, the banking system, the regulators, also acknowledge that no matter how much the banks try to protect customer data, there's this other universe of data or subset of data that they are not having access to, which exists in largely the online world. So on the 24th of August, the Central Bank of Singapore, MAS, actually made an announcement that all the banks that it regulates can now spend up to 10% of their capital base to invest in e-commerce and ancillary company that has nothing to do with banking, up to 10% of their capital base, so long as it's not a majority stake. So this actually is very interesting change, because now the regulators are saying that the only way for a bank to do a banking job better, i.e. to give loans in a responsible way, protecting the depositors, is actually to collect data, and one of the data sources is actually multiple online platforms, and they recognize that, so they're allowing that to happen.
So for you, which is more valuable, data or money?
Obviously, from the fintech world, I think data is the currency. It's the currency of now. In fact, if you look at fintech, it's a term that was only coined the last 3 to 4 years. I term that up to maybe around now as fintech 1.0, where you are just using information technology to better, faster, cheaper the whole processes of financial services. But going forward, fintech 2.0 is where you have a chance to use big data, science, methodology, ideology to reimagine banking services. Something that wasn't possible, that may not be offered by a traditional bank or a challenger bank, how can you actually make that happen? Because ultimately, every one of us do need financial services, whether it's insurance, it's loans, it's mortgages, it's just simple checking account. We all need that.
Yeah.
And if you look at in China, today the largest bank is not a bank, right? And the largest fund manager is not a fund manager. So, and financial, I mean, within 18 months, if I read correctly, they have exceeded BlackRock as the largest money market fund manager, simply because they allow the first RMB one, which is about 20 cents US, to earn interest on their e-wallet. Traditionally, you had to accumulate a certain amount to go to a bank, put it in and get your savings interest, but now you could have it in your e-wallet. And why the e-wallet and therefore the sort of unofficial bank became so popular? Because there was this phenomena, especially in China, where even from an ATM machine, you withdraw your cash, there's a chance that one note out of 10 notes is a counterfeit note. And there's nothing you can do about it. You can't go to the bank and say, this came from your machine, and therefore you must refund me back. They say, it's your problem. Right? But once you go digital, as long as it has gone into the system and it has been validated, then the money is good.
Right.
Digitally, it's always going to be there. And it earns interest from the first unit. So this is how it has changed banking in that part of the world.
Right. Wow. Well, I'm getting some questions in from the floor. The first I'm going to have to ask Aether. So it's from Anonymous. Denmark terminated national checks by the end of December 2016. Why don't you all just do the same? So why doesn't Brian Moynihan come out next Monday and say, checks, it's over?
Well, I haven't looked at my economic data recently, but I think Denmark's probably about a third the size of California. So I think it's very easy to say.
Where's the Great Dane in the audience?
I think it's easy to say, but the reality is, look, the United States as a regulatory regime does not have a history of mandating anything. If you look at how the Fed's approached faster payments or real-time payments in the US. It's been a very collaborative process with all different parts of the industry, from the fintech community, traditional banks, industry groups like NACHA and others, all being involved, sort of talking about the solution. It's just not the way they go. That said, also, it's still not a big cost for the industry because, call it 20 some odd years ago, Check 21 mandated we no longer flew checks around the world, around the country on planes. We just truncated them at the point of entry into the system and exchanged an image. So the cost is not really high, so it's not a high priority item.
Okay. Okay. Megan, I've one from you, also from Anonymous. Don't know if it's the same Anonymous. Starling Bank, how much focus or priority do you put on cyber threat to ensure client data protection?
Yeah, I think as any bank, it's a huge focus for us. Whenever we were starting the bank back in 2014, one of the key strategic decisions we made was to build the bank from scratch. So this was quite different from what we saw from other challenger banks who effectively saw the back-end technology as a commodity. But for us, we wanted to build the infrastructure in-house from scratch, because then should we have a new algorithm for detecting fraud, we can easily turn and implement that. But also it meant that we could really take stringent controls around cybersecurity and protecting our customers. And in the UK, there's also been legislation as of November of 2015, where now banks can use cloud hosting for the first time. So one of the things that we've done is we have a microservices architecture where we store our customers' data in AWS and in GCP. But it gives us a lot of benefits in terms of the security around data, in terms of availability zones, and being able to have a certain level of resilience and scalability that wasn't previously possible with a mainframe. So if all of a sudden there's a DDoS attack or something happens, then all of a sudden we can elastically scale that infrastructure to accommodate it, and protect our users and protect our service in that way. So it's something that we think through, like in every aspect of the organization. It's something that we take very seriously.
What proportion, I don't know if you can answer this, what proportion of your staff numbers are like IT specialists?
So we are a tech company, so it's funny because we don't have like an IT department. We all work, we have an office in Liverpool Street, and everyone is there, from compliance and risk, business, product, IT, tech, the engineering team. It's probably a third of the size of the company at this point, but we're all together. Customer support is in the same office. Yeah.
We had a question also, I think, similar on Starling Banks, asking about what was the future of retail banks focusing on branch networks. What's the future of the branch?
So we have a very strong perspective that the future is mobile. We have a mobile-first, mobile-only strategy. The way that our customers interact with us is purely via mobile. We don't see a benefit any longer for us in maintaining a branch network at all whatsoever. So we don't have one. We have no plans to have one. And what we find is that we previously had predicted that our first users would be the classical early adopters on the bell curve, and that would typically be the digital natives, 18 to 35, typically more highly affluent, often in technology roles. But what we found is that's not the case. What we found is it's rather age agnostic. We see it just as frequently in people who are 60 plus as we do in the digital native segment. And also across various income categories, it's also very evenly spread as well. And I think the reason for that is whenever we look at the rise of mobile usage compared to laptop, compared to tablet, it's just been this constant J curve. And so that's translating to financial services as well. People want to be able to do things automatically, easily from their mobile phone. Because what we've seen is basically banks were really good at keeping up with technology until about 2008. And then with the financial crisis, everyone's heads just turned to regulations, to the fines being imposed, and innovation just dropped to the bottom of the priority list. But that was the same year that the iPhone was launched, and then Uber and WhatsApp and Airbnb. And so this gap started to emerge between what consumers were expecting and what the banks were delivering in terms of product experience in particular. So whenever we saw this opportunity to really focus on giving customers a great user experience, for example, to open a bank account in the UK, it can take up to 6 weeks. You have to bring in lots of forms, you have to make an appointment, you actually have to go into the branch location. But with Starling, it takes less than 2 minutes on your phone. You scan your ID document, put in a few pieces of information, record a short video of yourself, and you're done. And so focusing on that kind of seamlessness and intuitiveness that you see from other consumer technology companies isn't something that you've seen in banking. It's really shifting the dynamic of what banking looks like and how customers access that service.
But surely the big banks could simply move to that model of not requiring you to go into a branch, right?
They could, but what we see is that they seem to think that they're doing it. Like they have a mobile app, so they've done digital. And then it's just kind of it, done and dusted, and on you go, you know? So now you can make payments via mobile phone. But I think what they are starting to realize is that it's more than that. It's about more than just having a mobile app. It's about the full end-to-end experience. How do you understand customer data and present it to customers in useful ways? How do you understand customer journeys and their pain points and solve those in delightful ways? It's really shifting this perspective of you start with the customer and you work backwards. What is best for the customer? And so often, like we have this very well-known API strategy. We were the first bank to actually launch a platform that's compliant with PSD2 and open banking. But it really didn't start as an API strategy. It started with figuring out what's right for the customer, and an API strategy manifests better customer experiences. So that's really the driving factor.
But some of the apps that you've launched, like the Goals app, for instance, which, correct me if I'm wrong, is all about basically how to save for a particular thing that you want, right? But to Richard's point about how you can use this data to decide whether you will actually, you can make it sort of a moral judgment on someone like, God, they've been saving for this holiday since forever, but they keep going and buying shoes, so I'm not going to lend them the money. Do you think at some point people will cotton on to this and say, you know what, I'm not actually going to give as much information as I did before to my bank, because I know really what they're trying to do here, in the same way that I won't have my Fitbit on when I'm going into the liquor store every week, right? I've got to be careful. I've got to protect myself. Could there be a backlash?
Yeah, well, it's an interesting thing. So banks have a lot of data, but that doesn't mean that they can access it or use it in meaningful ways. Right. Just having data doesn't mean anything. And so what we have a focus on is, one, not only being able to structure and utilize that data in meaningful ways within the company, but really in terms of enabling customers to use that data. So whenever we built out our API, we have this developer portal, and we have 5 different tiers of access. So if you're a fintech, another bank, third party, whatever, and you want to actually integrate our production API, you have to say what level of access you want. Is it read-only data? Is it personal data, transaction data? Do you want to actually write payments via the API? So because we're a bank, we directly connect into payment schemes, so we actually have a faster payments API as well. So depending on what access you need, though, that will dictate the level of due diligence and compliance we do, but we'll also present that to the customer. So we'll very transparently say, this company wants to access X, Y, and Z data. And we make sure before we even give them access to that the data they're requesting is equivalent to the value that they're giving our customers. And we also have a very strong perspective around PII. Do you need the PII data? Because what that means for customers, there's a huge education piece that we need to do. Whenever you share that PII data, what you're actually granting to that company. So making it very clear to the customers, this is the data that you'll be sharing, this is how you can easily revoke that data, and this is what it means for you when you do that, share that data. But also having a duty of care within our own company that before we even let other fintechs access our APIs, to do that compliance and evaluation for the customer as well.
So if I could just jump in real quick. So you asked the question earlier about who could be the Amazon of financial services, right? And it's interesting in this conversation about going only mobile. So Amazon launched 20 years ago, roughly, right? Totally online, expanded products. What are they doing now? They're actually opening retail stores. Why? Because there's a segment of the population that either wants to get something more quickly and pick it up, or they want to touch and feel things. And so I think about it as a bank that has 5,000 roughly banking centers, financial centers, branches across the United States. We look at our client population and you say that, yes, we have a mobile app, and yes, we're pushing mobile and digital for low-value transactional things and pushing information. However, as you think about the myriad of clients we have and the complexity curve of their financial needs, at some point you're going to want to sit down and talk to someone about how should I plan my estate? How should I finance this equipment buy? You're not going to want to do that over your mobile phone. Some people might, most won't. And so I think you have to have a balance and think about your client segments and their needs and how you fill them through the myriad channels available. They're all valuable. And yeah, look, I think that I've been in banking long enough to see this movie the first time when online banking launched, and every headline in these conferences were talking about the death of the banking branch. And then since then, actually, bank branches have gone up. ATMs came in, branches are going to die. No, they haven't. I think there's a reason for them, but even at our bank, we're repositioning the banking centers from being transactional places to places of sales and advisory. And I think that's the transition of how do you provide advice and become that trusted advisor to your client and not do transactions, because I would completely agree that mobile is a much more efficient way to conduct transactions and to consume information. But ultimately, when you decide you're going to buy that house and you need to take out that very large mortgage, you're going to want to talk to someone about your options.
We've got a big kind of existential question from the audience, from Clive Naker, saying, will we ever not need money? Will money as a concept survive past the digital age? Richard, is that something you want to take?
I think even in the digital form, money is still money. In fact, I read a story, I'm not sure how true is it, it's of a person who actually don't trust banks. So this person has got all the life savings in the bank. So every month, this person actually goes to the bank branch, still a bank branch, and say, withdraw all the money out, and then start to count, and make sure the money is still there, and deposit it back. And next month, this person comes back and does the same thing, just to make sure the money is still there. Okay, so the question is, the money during the month actually stays in the bank in a digital form, in a vault. Doesn't stay with this person who doesn't trust banking in general. But whether it's a digital form or not, I would say they're actually just different way of looking at the same thing. So we still need money. In a digital form, money is still necessary. But it's just a question of how do we make this money supply more efficient, going to the places that need it, and coming out from the places that have too much of it, so that they can make a decent return, and reducing all of the opaqueness. And coming back to the topic of big data, I think everyone talks about big data these days, but the biggest challenge of big data is that we have too much of it. That's why it's called big data. There is just too much noise. So if you were to look at an instance whereby, say, during summer, more people go to the beach. And then the ice cream vendor is making a huge sales went up because it's summer, right? And because people go to the beach to swim, and then the incidence of drowning became a little bit higher during summer. Does that mean that ice cream caused drowning? No. Yeah, but there's always a danger that when you start to look at all these data points, and you say A equals to B, B equals to C, therefore A must be equals to C. So this is where the danger comes in, that we sometimes have too much data, and we are unable to take out the noise, which is defined as sort of those with zero correlation coefficient. That has nothing to do with whatever you already have in the portfolio. But most of us, we do not know how to take that out. And so this whole data science these days is really trying to not collect more data, but to analyze it. And the first stage of analyzing is to get rid of the noise and those that give you a false hypothesis.
For you, do you have a view on who could be the Amazon of the financial services world?
Actually, I would say Amazon, Apple, Google, Facebook, and the Tencent, the Alibabas of both sides of the world, because they actually run a very large platform business that is very, very much part of your life. And these days, as you rightfully put out, they have now gone offline. They have actual stores that you go and meet a person, pick up your product, but data is still being collected. And it's quite easy for them to turn the cashier into a bank branch, because you could say, draw some money from my checking account, which is a mobile only or digital only, but I needed some cash, and I could take it out at the same time when I was supposed to be paying for my groceries. So in that sense, the bank branch has now evolved into potentially a supermarket checkout counter. And many of the things will exist in your phone because that's where you're tied up with your payment. So, so these are the ones that we have to watch. They are the ones who have so much data that the banks doesn't have, that they potentially, when they get a license, they could be doing somewhat what banks have been doing.
Yeah, I mean, you could have a little bank branch in your Whole Foods, which is now owned by Amazon, right? We have a question from the floor, but what are the biggest opportunities in fintech currently that aren't already saturated, so that are out there to be? Anyone want to take that?
I will try first.
Yep, please.
Actually, many have thought that fintech is meant to be disruptive. I actually don't quite think of it from the angle. To me, fintech exists in a space where traditional financial services player find it unprofitable to do that business. So they kind of left it out because they look at the cost structure, they look at the way you deliver the service, and you find that maybe they say, I've got bigger fish to fry. So this is an area where fintech sort of goes in and plays a role. At the same time, fintech could also be used to help the traditional banks to reimagine financial services as a whole. Because they are smaller, they take risk, and most of them are ex-bankers. So they have an understanding of the product, the regulation, the compliance, the whole regime, and they're able to go out there as a 10-man team, 20-man team to just experiment using VCs. Money, of course. And when it works, it actually signals to the rest of the industry that perhaps this is where more investment could go in and to make it into a bigger sort of sustainable business. So they do play these two roles of a white space and access as an incubation lab. And which is why many of the banks these days have an incubation lab. They have a corporate venturing arm to say, let's dress down, jeans, t-shirt, provide lots of pizzas
that's where the guys
beer.
with the hoodies work, right?
Correct.
Yes, it's
and
the fun floor.
ping pong table, and then you are fintech now. Right?
We got one of those.
What about for you, Aether? Do you see, you've moved to a new role. Do you see kind of opportunities maybe in the business banking world for fintech? Maybe, I don't know, are there ideas that you could take from your old role at Global Transaction Services that you could be applied, or is there opportunities that you see?
So I think that the first opportunity, I think, is around how you apply, provide credit, right? Because credit is generally the lifeblood for any business, or their capital. So it can be equity, it can be cash or credit. And I think that to some comments Richard made earlier, most large banks think of the process for underwriting a loan for a $2 billion revolver or syndicated credit for a large corporate the same way you do is a $3 million equipment line for a farmer in Northern California is harvesting grapes. Like, you think of it the same way, and it's just doesn't make any sense. Because for a large public company where you have all this massive data, it's very easy to get that underwriting right. When you're looking at a private company that may be sole location, single owner, it's very different, and it's very costly. And you generally don't necessarily get it right. It's really about that handshake and do I know that person?
Right.
So being able to look more broadly at a broader set of data elements and think about how you underwrite and understand the risk of that person's business, their network, very differently, I think can dramatically lower the risk of borrowing and therefore put more capital to work. Because to his point, we have to hold back a lot thinking about what the risk of these loans are and build in a risk premium and loss rates and those sort of things. So I think that being able to leverage fintech in that area could really allow us to unleash the balance sheet and really help drive more growth.
Right. For you, Megan, are there kind of the low-hanging fruit still out there?
Yeah, I think from a European perspective and a British perspective is that there's new regulation that's coming in that's creating new opportunities. So there was this recently a very interesting article in TechCrunch around the opportunity to basically build shovels for gold diggers based off of the new open APIs. So what it's really thinking of is there's going to be new opportunities for companies to come in, for example, to build like an API aggregation model. So right now, all of the banks are manifesting these APIs that should give access to customer data, but they're not very standardized at this point. So for any fintech to access them can actually still be a very arduous process. So for a company to come up and to basically aggregate all of those APIs and create one standard way to connect to them is one of the examples of the kind of shovel that you could build. So I think from that perspective, the regulation is creating new opportunities for both fintechs and the types of fintechs that you can build on top of the banking data, but also for people even just to provide access to that and to provide tools and resources around the data and the APIs that the government has mandated that the banks open.
Just wanted to add on, using the same analogy. I believe if I read history correctly, during the Great Gold Rush, the ones who built the shovel didn't make the fortune. Neither did the people who went to look for the gold. It was the jeans maker.
Levi's.
Right. Because of the riveted jeans, he made a fortune, even though he wasn't really doing the shovel nor digging for the gold. So sometimes in financial industry innovation, where we kind of tend to look at the existing process and we keep thinking, how can we make it more open, faster, better, cheaper? But sometimes we need to go off tangent in a perpendicular way to find out whether is there something else that is going on. Like I was just reading yesterday about this famous quote, supposedly by Henry Ford, to say, if you ask them, they will want faster horses. And later on I read that this quote wasn't actually from him, but urban legend has it that he said that. But as it turns out, that he wasn't really trying to solve the transport problem. He was trying to solve a manufacturing problem through assembly line, through financing, through replaceable parts. And at that time, people weren't really also asking for faster horses. Actually, faster horses or the slowness of horse wasn't really the problem in the late 1800s. It was actually the horse manure that was causing the problem to many large cities, because you have 100,000 horses, got to feed them, and they got to have a whole team of people to basically to clean up after them. That is the problem.
Right.
And yet the solution wasn't faster horse, It was a mechanical horse, which is the automobile. Right? So sometimes innovation takes place when you look really off tangent, solving some other problem, which turns out that it actually solved the core. Yeah, so that's.
And it's hard to plan for that, right? You want to be the person that comes up with that idea, but if it's kind of off on a tangent, then by its very definition, you're not going to think of it in a boardroom or.
So I suspect, using the China example of Alibaba, I don't think at that time when Jack created this big dream, he wasn't thinking that he wanted to go into financial services. But today, the pre-IPO and financial is actually the jewel of the crown. They are into everything, from loans to credit to mutual fund, money market, e-wallet, and everything. And yet, they exist because of that platform. They were able to harness the data. They were able to take the noise out of the data and make some sense of products, services at a price that traditional banks just felt that it was not profitable. So this is something worth thinking about.
Absolutely. We're coming towards the end of our time, and I think maybe we're going to run the poll one more time before we kind of move to final thoughts. So maybe if you could take out your apps again and maybe see what is more important, money or data? Oh, wow, really? No. Woo, you guys are influential. Oh, not that influential.
Move the needle.
We're closing the gap. So this is a sort of a fintech conference where we've managed to convince people that the old money is important. I don't know if that's a step back or a step forward. Aether, any final thoughts before we wrap up?
I would just say that I've been coming to Sibos since like 2003. And I think that the dialogue has changed daily, greatly. But I think we've hit a place now where it's much more about collaboration. And so I think it's great that the three of us can sit up here who are all coming at the industry from different perspectives, with different legacies and history. But also I think if we work together, we can actually solve some real problems. And I don't think that it's a zero-sum game between everything has to be mobile, everything has to be in a banking center. I think that there's a combination of things that are really going to help expand the pie and also drive the industry forward and actually better serve customers, whether it's individuals or companies. And I think that's the outcome we have to keep our eye on. And we as incumbents can't be afraid of change. We have to embrace it. At the same time, I think that having invested in and worked with a lot of fintechs through my prior role, there's a bit of naivety out there about how complex it is and how complex the regulatory environment is and how complicated these problems are to solve. And so we need to share a lot more to make that happen.
Richard, for you, any final thoughts?
I think data and money are just two ends of the same spectrum. And I mean, every year we're going to probably see this gauge going left and right. Actually, we're talking about the same thing. It's just, is it in a paper or check form or a digital form? But the data science behind the data is what is going to allow us to get some more new insights. Because data leads to information, leads to insights, and insights hopefully allow us to create products and services that will truly drive revenue. Because ultimately, we're still looking for the revenue. But we don't look at revenue from day one. We look at it from how can we get there by understanding the customer needs, the voices, their lifestyle, how it revolves around. And finally, the revenue will come in. But if we start focusing purely on just borrowing at 5%, lending out at 8%, that sort of traditional business may no longer be there. So we have to reimagine financial services using data, and data science in particular.
Right. Megan, for you?
Yeah, I would just echo both of those points, that I think everyone's agreed that there is disruption occurring within financial services, that we do need to reimagine the systems. But to Aether's point, the key to moving forward and what I think will enable us all to be really successful in this new environment is that collaboration among various banks and among banks and fintechs as well, to create this new sharing economy model within financial services that we've seen quite predominantly coming to surface in tech as well. So I think from a traditional banking perspective, those that will really last and really be successful in 5-10 years' time will be those that start disrupting their own products and services and their new revenue streams today to stay competitive.
No rest for the wicked. So that really just leaves me to say thank you to everyone for participating and sending in your questions. I'm very impressed that we managed to have a discussion that brought in KYC, PSD2, and horse manure. Thank you, everyone.